So the stock market has only had 3 negative weeks in the last 21 weeks. This is definitely a historic run of epic proportions. However, if we look at the S&P 500 earnings, they have essentially been flat for this year. So what is the enthusiasm about? Obviously, the enthusiasm is encircling the Fed rate cuts. The market is expecting the Fed to cut rates, even though initially they expected the Fed to do 6 rate cuts, and now the Fed is signaling that they will do 3 rate cuts for 2024. So in this video, I'm going to tell you why the stock market can get even crazier from here until the first rate cut. If the first rate cut even happens, more into that as well. And then I'm going to share with you the only index that I'm actually enthusiastic about buying here, and yes, it is based on data. The only index that I think can have a monstrous run without the downsides that investing in the S&P 500 or the NASDAQ at these levels come with. So let's dive right into it. As I said, the S&P 500 right now is acting as if the Fed is going to institute a ton of cuts this year. Although the market was initially expecting 6 based on the Fed's last dot plot, and now the Fed is signaling 3, so you would expect there to be some sort of repercussions for that, at least in the short term, and there still could be. However, the reason that the market is rallying like this is because a large number of market participants are acting as if this is the mid to late 90s. Now, why do I bring that up? I want you to take a look at this. This is an article that I've referenced before by The Balance. It is simply the best article ever written on the history of inflation, the history of GDP, and the history of interest rate hikes and cuts. So in 1994, we could see that inflation was 2.6%. The Fed on February 4th decided to raise rates to keep the economy healthy, even though inflation wasn't that crazy. In 1995, the Fed raised rates again on February 1st to 6%. Again, inflation was still below 3% in the 2.5% range. And then by July of 1995, they started lowering rates, lowering them once again in 1996. And inflation remained steady at 2.3% in 97, falling to 1.6% in 98. This is the soft landing that all of these pundits are referencing. The only difference here, and really it is the biggest difference, is that we weren't dealing with an almost double-digit inflation rate. As we see here in July of 2022, we hit a 9.1% on the CPI. And this is after they started fudging with the CPI numbers and making them easier. So this inflation rate could have actually been well into the double digits had we been using the old way of calculating CPI. And what happened after the Fed did that soft landing and they actually started cutting rates? Well, we saw one of the most historic runs in the S&P 500 in 1998, going up 57% to the year 2000. And then of course in March of 2001, we hit the official recession and the Fed was forced to cut rates once again. So all of this enthusiasm that we see here is not only based on the Fed cutting rates, but based on the hopes of a soft landing. Because when the Fed cuts rates, it's true that the market does rally sometimes. It really depends. I want you to take a look at these metrics here. There is this thinking that when the Fed cuts rates, the market tanks. However, that only happens when it coincides with a recession. When the Fed cuts rates in general without a recession, the market actually does pretty well and rallies. Here you can look at the 6 months change after the first rate cut. However, when those years align with major recessions, this actually isn't great news. So the hopes here is for a Fed soft landing. Now, the Fed has never cut rates prematurely during an inflation fighting cycle. So if you take a look at this, and I'm not going to go through the history of every single rate cut, but there are tons of times when the Fed is cutting rates in order to fight maybe the potential of inflation rising or to fight a high unemployment rate. But we have never had an inflation fighting scenario where the Fed has cut rates before inflation actually got to their target. So this is putting a lot of hope that the Fed will actually get to their soft landing. Now, here is where the market can continue to get crazy, and then I will tell you about what index I'm looking to invest in, actually have been investing in really heavily, more so than I have my entire life. If you take a look at the traditional markers that tell us when a recession is getting closer, such as the difference between the 10-year and 3-month treasury, or the difference between the 10-year and 2-year, these are actually far from uninverting. Now, a black swan event would really come in like a tidal wave, and you will start to see the yield curves uninvert. We will most likely be knocked into a recession. You will start to see the market tank from here. You'll start to see rates cut because of the recession. So this is all barring a black swan event, obviously. But economists have never been great at predicting recession. So again, barring a black swan event, it could take forever for these yield curves to uninvert, meaning it could take forever for us to officially get put into a recession. There could be a case where it's not even in 2024. It could be in 2025, which means that the hopes for a rate cut in June, which right now you could see here is a 63% 63% likelihood based on Fed funds futures bettors that 63% chance that the Fed is going to do their first rate cut in June. But if these recession markers are delayed and we continue to get such strong data that CPI actually hasn't come below expectations in the last 4 months, then the Fed will not be able to cut, in my opinion, until late this year or maybe not even this year. And the longer that the Fed holds those rates higher for longer, the higher the chance of something breaking. We'll start to see certain things uncover or come to the surface, just as we saw last year with the banking crisis that the Fed came in and saved the day. We might start to see this in commercial real estate. We might start to see it in foreign economies as well. And then when the Fed finally cuts, it will be because they have to. So we have never actually hit a soft landing, as I said before, when we are fighting heavy inflation. We have hit a kind of soft landing, a pseudo soft landing. When the Fed raised rates, they were actually being responsible by raising rates well ahead of time when they didn't need to. And then once they cut, the market rallied significantly. But in this case, the Fed waited way too long to raise rates. Inflation got to near double-digit percentage, and then they cranked up the rate hikes. And now the market is rallying on the hopes that the Fed actually cuts and we get a soft landing. Now, I'll be the first to tell you, if we actually do achieve a soft landing, which in my view is a low likelihood, yes, I think the market will continue rallying just like we did in the late 90s and could go on for a multi-year rally from here. And this is a perfect segue into why I'm investing in small caps more than I've ever done before in my life. Now, I want you to take a look at this alert here that I sent out in the Traveling Trader Academy November 10th. IWM has one of the most interesting patterns, and I highlighted how it was forming a fractal pattern just like it did back in 2011. Same thing happened here, and it was at the 50% retracement of the previous rally from the pandemic. I also was paying attention to the fact that small caps as a percentage of total market was in the worst positioning that it has ever been, even worse than the Great Depression. And as you know, on this channel, I like asymmetrical bets. I like extremes. When I see these types of extremes, it actually makes me pretty optimistic as an investor. So I bought into the small caps, expecting them to follow the S&P 500, and lo and behold, we are up 24% on IWM. And if you want access to all of our real-time alerts so you are not late and you don't miss this 24% type of gains, link is in the description below. I gave you Celsius at 49. I gave you IWM back in November. I gave you the SPY at 410. I gave you the long on gold, which was actually my biggest play last year, ended up netting about $14,000 per contract. So make sure that you sign up using the link in the description below. Now, in order to get back to all-time highs, IWM still has another 20% to go. Meanwhile, NASDAQ and the S&P 500 and the Dow Jones have all three of them hit all-time highs already on flat-ish earnings. And here's something you might not have picked up, that post the last Fed meeting, look at the performance of the Russell 2000 versus the S&P 500. Now, one other thing you may not know is that when large caps outperform small caps by this large of a margin, by this wide of a disparity, you can see here, going back to the dot-com bubble, here is the large cap line here in red, right? The small cap line is in green. When large caps have outperformed small caps, especially going into a recession, small caps have then outperformed large caps for a number of years. Going back to 2000, in the 2001 recession, small caps outperformed large caps for 5 consecutive years after that recession. We are now starting to see that kind of disparity once again. Here you see in red, these are the large caps, and you have the small caps again in green. And here's another chart showing you the disparity between the S&P 500 in blue, the S&P small cap ETF in orange, and the Russell 2000 in purple. And you can see that disparity is growing once again. Now, I got this question last time when I talked about the IWM, or when I talked about small caps in general, is that if we get a black swan and the market crashes, isn't IWM going to crash too? Yes, of course it is. But one, history shows that small caps do not crash as large as the mega caps when there is this wide of a disparity. And two, as I said before, humans are terrible predictors of recessions. So if I'm looking for something to invest in now, am I going to be investing in the S&P 500 and the NASDAQ at all-time highs with flat-ish PE ratios on most of these mega caps? Or am I going to look at something that has underperformed, that historically, if the market kept rallying, would catch up to the market and meet its all-time high, which is 20% away? In other words, am I more confident that the S&P 500 will cleanly make another 20% rally? Or do I think that small caps have a better shot at reaching their all-time highs because they are lagging behind? Now, please hear me out. I'm not saying that the Russell 2000 is more valuable than the S&P 500, or that the companies in the Russell 2000 to me are more bullish than the S&P 500. I'm not saying that. I'm just talking about from this level here, where is there an opportunity to invest in, and where is there more upside versus more downside? That's all. Because if the S&P 500 continues rallying for another 20%, my bet is that the small caps also will then follow along. If the S&P 500 is stagnant, I think the small caps can also still see a rally. If we do see a crash in the mega caps, then historically in this type of scenario where there's a wide disparity between mega caps and small caps, that the small caps won't suffer as bad as the mega caps. Now, this is coming from somebody who invested heavily in the SPY in 2022 and 2023, as well as QQQ. So it's not like I'm sitting here trying to pick an investment late in March 2024. But for those reasons, if I was to choose an index here, it would be the Russell 2000 as well as IJR, which is the S&P 500 small cap ETF. That is it for this video. If you guys are wondering about what else I'm rotating into and you want my real-time alerts, make sure you check out the link in the description below. Come join the Traveling Trader Academy, where we are also day trading options and futures on a daily basis. If you are serious and you want to work with me personally, that link is also in the description below. But please be serious. Don't waste my time, as I won't waste yours, and I will only provide you value if you are accepted. Leave it in the comment section below. Let me know if you guys think that Jerome Powell is actually going to cut rates this year. Are we going to see no cuts? Are we going to see 3 cuts? Let me know what you think in the description below. Are we going to hit a recession? Are you confident in the Fed actually achieving a soft landing? Would love to hear your thoughts. I try to respond to each and every one of your comments. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.